How can we reduce global emissions and help others stay accountable? We must improve how we measure and track our progress in the battle against climate change, meaning carbon accounting must become more accurate. To dramatically improve accuracy, carbon emissions data sharing between organizations needs to become more granular and, more accurate. While both carbon accounting and data sharing can be complex topics, let's use an analogy to illustrate what data needs to be shared and be more accurate so that carbon accounting can dramatically improve and help us achieve global sustainability goals to save our planet. So, let's say we need to manage our sugar intake, like a diabetic, analogous to how a company needs to manage its carbon output. We need to have accurate sugar information for everything eaten. How do we track that information? Nutritional fact labels that are disclosed with foods. Carbon now has an equivalent of this called a product carbon footprint, or PCF, that will soon be available for a wide range of products. Great. However, common in most analogies, there are issues. These scenarios work just fine for single ingredient products like a raisin or a cup of milk. But what about products like a complete meal or a slice of cake that are made up of many ingredients? Nutritional facts of these products rely on accurate information sharing by each supplier of an ingredient. For example, Raisin Bran, a common cereal, has two main ingredients, raisins and bran flakes. The maker of the cereal directly produces the bran flakes but gets their raisins from a supplier. In order to provide an accurate sugar count for a bowl of cereal, it will need to have an accurate amount of sugar included for the average number of raisins in a bowl, or a serving size for raisins. What if the cereal maker were only required to provide nutritional facts for the ingredients that they directly contributed, not including the raisins? This would result in an inaccurate sugar count for the consumer, which would have adverse effects on their health, possibly leading to legal recourse. What if the supplier of the raisins makes a mistake in calculating the nutritional information that they provide to the cereal maker? For example, if it accidentally used the code for prunes in its calculation, then the sugar content of the label would be higher than it actually is. This would result in the cereal manufacturer having a higher sugar count for the bowl of cereal than their competitors, resulting in decreased sales. So, there are both regulatory and competitive reasons for having accurate nutritional data sharing between these parties as they work to calculate their own nutritional labels. Sharing accurate data between these parties also provides a way to look for opportunities to reduce sugars in finished products. For example, not sugarcoating the raisins before sending them to the cereal producer. Another issue with this analogy is that determining what a product's carbon footprint is way more complicated than determining sugar content in a product. Many aspects of making a product generates carbon emissions, not only the emissions from each ingredient of a product, but also the energy consumed by the factory, the fuel type used by employees to get to the factory, etc. There are many inputs for carbon accounting, and any one of them that is off by even a slight amount can have dramatic impacts as it cascades downstream through a supply chain. So having a product carbon footprint isn't enough. There needs to be more transparency about how the PCF was calculated to be able to find inaccuracies or gaps in the data. Some basic knowledge of carbon accounting is required to understand what challenges exist around sharing of PCFs. One of the major sections of carbon accounting is called Scope 3. That includes emissions that are indirect and not from the consumption of energy or utilities, but from the products received from suppliers and sent to consumers in the operations of a business. If we focus on one category, Scope 3, Category 1, or purchased goods and services, we can demonstrate the difficulty of achieving accurate results due to a lack of data sharing, i.e. transparency. Imagine a manufacturer of the widget that it sells to customers providing a PCF so they can understand the carbon intensity of each widget they purchase and add it to their own Scope 3, Category 1. To keep things simple, let's say that each widget requires a part that the manufacturer purchases from its supplier called a thingy. And the supplier of the thingy also provides a PCF for it so that it can be included in the PCF for the widget. The supplier of the thingy depends on their supplier of a raw material called Material X that they use to make the thingy, but the supplier does not provide a PCF for Material X. The supplier doesn't want to not include the carbon intensity of Material X, but they also don't want to potentially overestimate its impact in the PCF for the thingy. So they select a favorable factor or estimate for Material X. This seems to work and satisfy the requirements for a while until an investigative report hits the media about the negative environmental impact that Material X has, and the manufacturer of the widget experiences both regulatory and consumer impact that forces them to pull the product and look for alternatives, costing millions. Under the current scheme, there was no way for the manufacturer of the widget to find out how the supplier of the thingy calculated its product carbon footprint, not knowing that the supplier of the thingy took the path of least resistance and looked to minimize its own PCF by choosing a favorable estimate is an example of cascading impact down the supply chain. Thus, getting accurate carbon footprint data in a supply chain is becoming a pressing issue. As consumers and regulators are beginning to demand more carbon footprint data, as they did with nutritional information, it becomes a driving force to influence purchases of lower emission products. This will increase the pressure to reduce carbon emissions in a supply chain and become a competitive driver for all businesses. Demand for more data to have deeper insights and uncover opportunities to improve upon carbon intensity runs into friction when it comes to sensitive supply chain data. How can suppliers protect private supply chain data while at the same time satisfying their customers? Enter Dataspaces, which provides the data sharing capabilities that would have enabled the widget manufacturer to have controlled data sharing with their thingy supplier and be able to determine that there was a significant gap in the calculation of the thingy's PCF, and thus avoiding the whole situation. How do Dataspaces work? Find out in part 2 of this series, How to Share Data.